Hello, a very warm welcome to everyone who is joining us here today. I'm Victoria Scholar. I'm Head of Investment here at Interactive Investor, and I'm going to be hosting today's panel all about the recent stock market run. Thank you so much for being with us for this special webinar session as we head towards the final couple of months of the year. Can you believe it's nearly Christmas again, and into 2026? The year draws to a close. That's really the big question we're going to try and tackle. Of course, none of us have a crystal ball, but we certainly have some very intelligent panelists who will help to give us an educated guess. And we want to cover off some of the market trends that we've been seeing lately, some of the opportunities, both in terms of regions and sectors, and also have a chat about how to position portfolios to navigate all those uncertainties out there. We're aiming to run for about 40 minutes, and so we're going to start by introducing our panel, then we're going to have a discussion around the desk, and then we'll get on to some of those questions. A lot of you have kindly already sent in questions, so thank you so much for those. We've received some truly fantastic questions in advance, which have really helped us to shape today's discussion, so a big thank you for that. If you haven't already, then do head to slido.com and use the code 1690663, and those questions will come directly to me. The Slido code can also be found in the YouTube webinar description if you didn't quite catch it, and there's also a QR code on screen, so you can use that to get to our Slido page. You've got until 12:15 to send in your questions, so a little under 15 minutes, and we'll hope to answer as many of those as possible. Also, just to mention, this webinar is for educational purposes only and does not constitute financial advice. But in terms of our questions on Slido, popular questions will be given priority. So if you see a question there that you like, if you click the thumbs up button, then it will be pushed up and more likely to get responded to. So I'm a little bit conscious of time, got just under 40 minutes, so let's begin by introducing you to our wonderful panellists. We've got to my left Richard Hunter, Head of Markets here at II, 35 plus years of experience in UK and US equities. Then we've got Dorian Carrell, Head of Multi-Asset Income at Schroders, and he's an expert in convertibles and macro strategy. And then on our left, we've got Simon Fox. He's Global Head of Multi-Asset Bespoke Solutions at Aberdeen, and he's worked with pension schemes, foundations, and insurers, both to help design and also manage their investment portfolios. So as you can see, decades of experience across lots of different parts of the market. So hopefully we'll be able to answer all of your questions. Right, so let's get to it. Richard, let's start with you. The Nikkei passing 50k, the FTSE near all-time highs, records on Wall Street, improving US inflation data, US and China close to a trade deal. I mean, what's to worry about, right? I mean, but in all seriousness, can you give us a sense of how markets are doing at the moment? How have equities performed versus your expectations so far this year? What's kind of the market mood at the moment?
Well, it seems a long time ago in April when we had a so-called Liberation Day and the announcement of Trump's aggressive tariffs. As time has gone on to date, the effect of those tariffs has been fairly muted. Number one, because he's tended to dial back on a lot of them.
Yeah, the taco trade.
The taco trade. Trump always chickens out. And number two, because of the limited increases we've seen in inflation, a lot of companies have chosen to take it on the chin rather than pass it through to the consumer. The easing inflation of late, to which you referred, has also helped out the Federal Reserve because they've got a dual mandate to keep an eye on inflation and the labour market. There are some signs of stress in the labour market, and with inflation being reasonably benign at the moment, they can switch over to concentrate on the labour market side of things by potentially decreasing interest rates and therefore boosting the economy. And it's all but penciled in now for an interest rate cut this week, and another one in their last meeting of the year in December. So that's US markets, record high. Japan, you mentioned, just passing 50,000, Nikkei 225. A lot of that, of course, Of late, the optimism has been around the appointment of a new Prime Minister, who is seen to have some very market-friendly policies, and even the beleaguered FTSE 100 has come back into fashion as a global investment destination. It's very much also been helped by its constituents. It's a slightly different story to either the US or Japan. We've got a lot of mining stocks in the FTSE 100, and obviously gold and silver have been on a particular tear. We've also got a lot of defence companies, and unfortunately, geopolitical concerns have resulted in a massive increase in defence spending this year. And also the banks, regardless of where interest rates might be or might be going, the simple fact of the matter is there are no immediate signs of strain in terms of the consumer. Banks are awash with cash, and positively, that's resulted in higher shareholder returns, both in terms of share buybacks and, of course, dividends. So, of course, and we're going to get onto this, I'm sure, every bull market climbs a wall of worry. There are some underlying concerns, despite the record highs we're currently at.
Yeah, so that wall of worry, Simon, I think obviously the big kind of discussion for investors at the moment has been all about this AI potential bubble. We've had warnings from OpenAI's Sam Altman himself, the Bank of England, the IMF, Jamie Dimon from JP Morgan. So I guess the big question that no one knows the answer to, but everyone's trying to figure out is this bubble going to burst? And if it does, how concerned are you about that kind of concentration risk? Because we've seen a handful of stocks in the US drive global market gains. And so if we did see a sell-off, then we know that could have potential widespread implications.
So just to put things into context, within our multi-asset portfolios, we are pro-corporate risk at the moment. We're leaning into equities, we're leaning into the rally that we've had so far this year. So generally constructive on the outlook, even with the gains that we have seen. And I suppose a key part of that is that we believe the AI theme still has further to run. I think it's important to note that it's not the same sort of situation that we found ourselves in the early 2000s.
Okay.
In the early 2000s, there were lots of lots of companies that were not profitable that were seeing huge price gains, and that's clearly not where we are today. The Magnificent Seven, their price appreciation this year has been fully justified by the earnings coming through over the course, and indeed over the course of the last few years. So the valuation levels we see today are not, from our perspective, in bubble territory. That's not to say they're not expensive, but we do think there's much further for them to run at this point in time.
So there's probably quite a lot then riding on earnings season at the moment. We're in the midst of US earnings, and we get a lot of those Mag 7 names just this week: Amazon, Microsoft, Apple, Meta, and others. What are you expecting there? And we know that they tend to outperform on the day. Earnings often do a bit better than expectations. So if we were to see any weakness come through, could that spark some kind of selling?
It would. We've already seen Tesla get punished for a reasonably decent set of results, and of course with higher valuations come higher expectations.
Yeah.
And that's been ramping up every quarter for the last couple of years now. So it really depends. If they are in line or in excess of expectations, the share prices shouldn't suffer. But equally, particularly given the global backdrop at the moment, investors will be very interested in outlook comments and how we're currently doing in the current quarter, because obviously there's a bit of a data vacuum in terms of the US government shutdown, with the exception of that inflation report. It's now a question for investors of turning to the companies on the ground to see how it's really going.
And Dorian, what about you? What are your thoughts on kind of AI valuations at the moment?
Yeah, I mean, we kind of disagree a little bit with what's been said, in the sense that we think that the mega cap tech is not AI. The two tend to be kind of used together. And the reason we're worried about mega cap tech is more that the amount of spending that they have to do now through cloud, through infrastructure for AI, through data centers, is changing their business models quite materially. So when you look at the NASDAQ, you've got a multiple of plus, higher than 30 times. You've got growth expectations of mid-teens. You've got great expectations in that space. So what we'd suggest is that you broaden out your AI exposure. You look internationally, you look at Europe, you look particularly at emerging markets, and you look at areas where they're not so confident in the minds of investors in terms of expectations, especially if they're moving from an asset light model, which is very profitable, to an asset heavy model. We think that could be a danger, maybe further out, as you say, but we do think that's a bit of a warning signal at the moment.
Yeah, you were saying that big cap tech and AI are sort of quite separate, but isn't it just that the large cap tech players have been fueling this AI boom? And if we look at Apple, that seems to be a bit behind in the generative AI race, its share price has actually been punished because of that.
Well, that's the thing. I mean, so basically AI and mega cap tech are synonymous in investors' minds, and that's fine. But we just think there's a lot more to it. There's the picks and shovels of AI. As you go down the supply chains, they're much cheaper, and there is also a degree of circularity between OpenAI, NVIDIA. There are some great graphics that have come out from Bloomberg recently, where you have a lot of investment going from one company to kind of guarantee a revenue stream from someone else. If you saw that in emerging markets, I think people would start to wonder a bit.
Yeah.
But it tends to be there's so much optimism in the space at the moment. It seems to be like that.
Yeah.
And I think one of the other positives at the moment is that investment is not debt funded. So there's a lot of cash in these companies, and they're able then to recycle that into some of those investment opportunities. I think there's sort of 350 billion of capex spending this year coming from those big tech names, and that's going to be positive for the sector going into next year as we go forward.
And without being alarmist about it, that's kind of running out though. So they had a lot of cash, but if you project forward 2 years, 3 years.
With these hundreds of billions of dollars of spending, it's not going to last forever, is it?
Big numbers, basically.
So just switching focus slightly, this is something, Richard, you touched upon. Dorian, I know that inflation is one of your big worries, and it seems to be coming back into focus with the Fed starting this cutting cycle. It's expected to cut rates this week. We had that better US inflation data last week, the smallest monthly increase since January of 2021. Does that help ease your concerns at all, or is that a bit short-termist?
Seems to be cast as the most negative person here. Well, no. I suppose, if you look at the inflation numbers, the CPI on Friday in the US, and you strip out autos from the goods component, and you strip out housing, which is a very complicated kind of lagging calculation on the services side, you get to 4% each. That's double the target. But as you mentioned earlier, the rate cuts are baked in, 2 to the end of the year, 6 by the end of the summer next year. That brings you down below 3% in the States. And if inflation, as looks likely, and I think you kind of mentioned this before as well, hovers around 3%, say, in the States, that means that your real rates, your inflation-adjusted interest rates in the States could be 0 or negative next year, which, if you put it together with tariff policy, geopolitical friction, it's a fairly inflationary cocktail. Yeah,
so if we think about kind of ways to protect the portfolio, a lot of investors have been moving into gold, and it's kind of confusing because we're seeing equities at all-time highs, but gold also at all-time highs. So it feels as though there is this kind of underlying confidence in markets, but on the other hand, we're also seeing this kind of major flight to safety. Do you think these two views can coexist going forward, or is something mispricing somewhere?
So gold for many years we sort of tried to value by looking at the comparison to real yields, and within that there was a sort of flight safety element as well. The last few years it's clearly disconnected from that. We've seen huge buying by central banks, and that's increased prices in a way that is not sort of explained by the historical financial models for gold. The key question is, where do you go from here? And having seen those price rises, are we starting to see the retail investors come in that would potentially sort of bring us back to looking at in that sort of framework? But of course, clearly last week we had the big sell-off and some concerns around where gold is going to move from here. So it's always a tricky one to be able to try and value and therefore predict, which way is it going to go in the short term. We think there is a structural argument for having some gold in portfolios, but it's a relatively small position within a broader asset mix, as opposed to thinking this is a time to be putting a big swathe into gold as a sort of tactical play.
Do you guys echo that view?
Yeah, I mean, absolutely, and it's all about sizing, and we think it's one of the three kind of hedges you can have. So you have the dollar, you have potentially duration, which we'll probably come on to speak about a bit later, and you have gold. You don't have much that can hedge you at the moment, and within that context, gold certainly makes sense. I mean, levels and pricing and valuations are something that we find a little bit troublesome, because it's very hard to kind of pin them down in this space.
Yeah. Yeah, you mentioned the US dollar, and a lot of our customers obviously hold UK equities and funds, but also have international exposure in the US and elsewhere in dollar-denominated assets. And this year we've seen this major US dollar depreciation that's kind of gone against recent history. So it's been a big theme for investors. It has moderated a bit lately, but largely the trend is downwards this year. How do you think that investors should be thinking about this depreciation in terms of their portfolios?
So for a UK-based investor, generally speaking, we've been relatively positive about keeping our US equity assets or other US assets unhedged, so accepting some dollar exposure sitting alongside them, because historically that has provided diversification. When things have been problematic with the world, the dollar has acted as a safe haven, and sterling, certainly post-Brexit, has been pretty pro-cyclical. So it's tended to.
Do you still think the dollar is a safe haven in a Trump world?
I think yes, well, this is the big question. How much do you think it's going to protect you in a really negative growth environment, versus do you think there's going to be a cost from holding it because the dollar could depreciate from here? That used to be an easy trade-off for us. I think it's got a lot harder. But when you get to any big tail event, we would suspect relative to sterling, you would get some protection from having that dollar exposure. So there's been a trend, I think, from large institutional asset owners to hedge a bit more of that dollar exposure. That's part of the weakness that we've seen coming through this year, and you could see some more of that over the years ahead. But generally speaking, leaving some of those US equity assets unhedged would seem to be a reasonable position from a portfolio context, even if there are some shorter-term drivers that you need to navigate.
Yeah, Richard, what have you made of the weakness in the dollar this year? Do you think there's further downside to come?
It just shows how quickly everything's changing. I mean, going back to the last question, it was always advisable to have 5% of your portfolio in gold, of course, just for that, that possibly the kind of situation that we find ourselves in at the moment. But I think by the same token, if you imagine that we could be in this situation of a weaker dollar, again, traditionally, the dollar is inversely correlated to the price of both gold and oil. And 5 years ago, if we'd seen these movements, we might have said, well, that's obvious. But of course, oil has been on a downward spiral this year, while gold has, as you mentioned, been the subject of other buying pressure. So there's all sorts of connections which are not playing out that they might have done in the same way 5 or 10 years ago.
Yeah. Okay, just switching focus, I wanted to ask you, Simon, about some of the risks stemming from the private credit market. Can you just explain to us a little bit about what's going on there, in case people aren't up to speed? Because obviously it's been in the headlines lately with the collapse of First Brands Group and Tricolor in the United States. Is this a risk that we should start really paying attention to? Are we going to start seeing it spread and have a potential wider impact on public equity markets, for example?
So I suppose if you take a step back, the growth of the private credit markets over the last, 15 years, following on from the financial crisis, has been meaningful, but it's also been pretty logical. Banks have stepped back from lending, large asset owners have been there with capital and a longer time horizon and able to provide the sort of direct lending that has fueled a lot of that growth in the private credit space. So when we talk about private credit risks, I think we need to be careful that we don't lump every piece of private credit into that sort of framework. There are certainly some concerns that you have interdependencies that have grown up, and that's where you then don't know quite what would happen if you have weakness in one part of the private credit space, and is that going to then span out and affect other institutions, and particularly impact the banking sector more directly. So that's sort of the concerns that we have at the moment. If you look at generally at sort of the sustainability metrics for credit, we think they are pretty good as things stand. Spreads are still quite tight. No general concerns from our perspective when we look at the banks. But that will be the area for us that you want to focus on if we get more nervous that those credit spread risks could increase.
Okay. Anything?
Yeah, I mean, we're a little bit worried about the accelerated growth in private credit. So it's 2023, it was like 1.7 trillion, now it's 3 trillion, it's almost doubled very fast. And as you were saying, as long as it's held by institutions, that's great, but the retail investor is being encouraged to come in now. And we do have concerns about the frequency of valuations, the level of transparency or not within the asset class. But as you were saying, I think it's the feedback loop to banks, because banks are lending to the private credit space, and that's often not seen. It's kind of off balance sheet. And so if there was a systematic or systemic even concern, it would be in that space. So something to watch, but with rates coming down, it's all floating rate, probably okay.
Okay, and then just very quickly round the table before we get into our Q&A from our viewers and listeners, just a quick outlook in terms of how you're feeling about markets as we head towards the start of 2026. Richard, let's start with you.
Let's start with the easy one. Valuations are definitely punchy at the moment. As long as companies continue to keep their side of the bargain, there could be further room to run. Still got concerns over what could be a latent bump in inflation from Trump's tariff policies. We'll have to see how that plays out. And I think from a broad perspective, it has to be said, and I mentioned it earlier, that the UK's FTSE 100's return to form, given the diversity and stability of its constituents, could also have further to run. So I'm going to leave that on an optimistic note.
Nice.
Yeah, I mean, we'd echo that. We just say that, the opportunities are where expectations for growth are lowest and you're paying less for them.
Yep.
And that's definitely outside the US. It could be in the FTSE. Could even be, you talked about energy earlier on. Energy stocks are super cheap. They're very high dividend paying. Geopolitical hedge potentially there with supply being cut through deals with India about supply from Russia. So there's an awful lot going on at the moment, but we'd say look outside the US in particular. Japan now has a leader whose idol is Margaret Thatcher. Make of that what you will, but there's change going on in quite an interesting way.
And so I said at the start I was pro corporate risk and leaning into the rally. That's true in the US. We're also looking at Asia as the other place where we find some interesting opportunities, partly about the replacement of the tech theme. Tech players in China are at meaningful discounts to those in the US, so we think there's some really good opportunities there. But more generally, the sort of the China opportunity is something that we are pretty positive around within portfolios. So.
All right, brilliant. Okay, let's get on to our Q&A now. And actually, we just got a question through relating to what you just said. So I thought I'll start there, which is what's a kind of good geographical balance to strike? So Stuart here has suggested 35% to the US, rest of America's 5%, UK 20%, Europe 25%, and Asia and EM 15%. Do you guys have any thoughts about it doesn't have to be a specific number, I don't want to put you guys on the spot, but I get the sense, Simon, that you're still quite pro-US, whereas Dorian, you're more into a bit more global diversification.
I think so. I can't speak
so from building a multi-asset portfolio, our starting point for our equity allocation is always market capitalisation. So we would always look at MSCI World as the sort of the initial framework, which gives us a large tilt to the US that we have to appreciate at the moment. Magnificent Seven are driving 25% of the global market capitalisation at the moment, so you end up with a big bias towards the US. We would also have a structural bias to emerging markets alongside that, and so typically in the sort of the 10 to 15% range is the way that we would think about starting a portfolio basis. And it's then from that framework we're looking at, well, where do we want to tilt, where do we find the most interesting opportunities at any given point in time.
Do you have anything to add there?
Just that, the starting point for MSCI World is pretty extreme at the moment. So, the index itself is distorted. And if you kind of reallocate or rebalance, as you suggested, it looks a lot more rational from a valuation perspective.
Okay, so we've had quite a few questions about macro risks and indicators. One here says, what indicators should we be looking at that warn of a correction given investors' extreme risk appetite and immense risks like geopolitical issues and stagflation? Now, we know there's no shortage of macro risks out there, and there's also a lot of different indicators that people can look at, whether that's VIX in terms of volatility, or the RSI on more of a technical basis, or I think there's a Buffett indicator, there's a Goldman Sachs, and lots of banks even have their own now. Have you got any good kind of insights into where investors should be looking for the clues?
Yeah, I mean, I think you have to start with the job market, and there's a danger that the data's not great at the moment, but we're in a low hiring, low firing environment, so it seems. Supply of labour is drying up in the US because of immigration policy, and so investors really need to recalibrate their expectation of what a good payrolls number is, but that certainly, if that turns negative from a sentiment perspective, that could be pretty tough. We spoke earlier about spreads and leverage adjusted or interest coverage adjusted. If the fundamentals of credit companies that we can see start to deteriorate, if there's a big M&A cycle, for example, which does look quite likely going forward with AI as a kind of kicker, that would be a problem. So indications of stress would be labour market or fundamental related for us.
Yeah, and I would agree with that. I suppose the only other one to add in is you look at the sort of the consumer sentiment surveys in the US, and they're not looking particularly strong at the moment, and they are just sentiment surveys rather than anything else. But they're potentially an additional sort of guide sitting alongside things like the jobless claims.
Yeah, and a bit more forward looking. So another question here on the kind of macro risk topic is how to prepare for a market downturn. I think kind of the jury's out about whether we're in an AI bubble or not, whether that's going to burst. As I said, none of us have a crystal ball, if only we knew, but it probably is prudent to prepare at least for that scenario. We've talked a bit about gold. This question is asking which assets are currently viewed as safe havens, but some people see gold itself as being in a bubble. Richard, what do you think about potential safe havens and where investors should be diversifying towards?
One of the reasons this question always comes up, and it's so difficult to answer, is that it depends on the structure of your portfolio. It may well be that you're already hedged sufficiently. And of course it also depends where any market stress comes from. If it comes from over there and you've got no exposure, you can carry on merrily. So whatever answer we give it, it's going to be fairly generalist. I would actually argue that apart from the traditional defensive sectors such as utilities, supermarkets and all the rest of it, notwithstanding the potential canary in the coal mine of private credit, I would argue that the banks are actually quite defensive themselves at the moment. I think the other thing to mention is, as we saw a couple of years ago, and our customers in particular, is to try to very much step back outside of the noise and not to panic. A loss on paper is not a loss until you sell your shares or funds. And as a general rule of thumb, although of course it can't be guaranteed forever, it's better to take more of a sanguine approach regardless of the fact that there's a couple of bricks falling off the wall.
Yeah, and kind of thinking long term, right, rather than trying to kind of hop in and out of the markets. Dorian, I know you're an EM guy. We've had a few questions about emerging markets. Quite a simple one, possibly not that simple to answer. What do you think of emerging markets, equities and bonds? Quite a broad brush question there, but I think something
it's definitely not. Yeah.
Definitely something people are interested in.
Emerging market equities, the growth expectations going forward from a very, very low base, and we think they're realistic of more than 10%. But you're paying a lot less than you are for other regions. So broadly speaking, in equities, that's very cheap. I manage convertible bonds. Interestingly, Asian convertible bonds are outperforming Asian equities at the moment. So if you can find kind of a balanced exposure with positive relationship with volatility, that's quite an interesting way of doing it. On the debt side, probably best to look at Latin America. You can see real yields in Brazil, interesting opportunities in Peru, Chile, overnight. Obviously Argentina now is very much to the fore with the US providing a backstop as well. So debt, probably more Latin America. emerging market equities Asia, which dominates the index anyway, but maybe trying to find interesting ways to play it that are not, overly exploited.
Yeah, so kind of leading on from that, one question here says, which of the larger emerging markets do the panel feel are undervalued as a result of the US tariff negotiations? Now, we've got this potential trade agreement between the US and China just over the last couple of days, and the meeting this week between the two leaders. So do you think there are kind of areas where some parts of the market are undervalued as a result?
Yeah, if you look at China, the economy is not doing well. The property hangover still continues, but you can pick your spots. So if you can find an area that's exposed to kind of tech, stroke AI infrastructure, cloud, e-commerce in China, and there are definitely segments of the market that you can allocate to. That's a big opportunity still. We think it's much cheaper, as you were mentioning earlier, than the US equivalents.
So you think a lot of the AI, kind of best AI opportunities are actually outside of the US?
Yeah, we do. Not in terms of the business potential, but in terms of the valuation discount. Secondly, Korea's on the verge of an agreement, we think, with the US as well. There are sectors, obviously, similar ones in the supply chain for AI there, but also interesting diversifiers like shipbuilders, for example, where there's a potential agreement between Korea and the US to build the US shipbuilding industry, which is something I don't think any of us thought we'd be talking about in 2025, but they are.
Anything to add, Simon?
No, that's the sort of the same sort of areas that we would point.
We've had a lot of questions about market bubbles, and obviously we have talked about it a bit already, but we're trying to figure out, this question says, how big is this bubble versus history, e.g. the dot-com bubble or the 17th century tulip bubble?
We weren't around for the tulip.
I've been at Schroders a long time, but you were mentioning earlier about 1999. I think, what we were saying is the difference is that there is a lot of cash flow generation and earnings this time round. The question is whether that will be maintained given the scale of the build-out of data centres and so on, which are hard physical assets. The second thing I think to watch, and it's one of your warning signs maybe, is the price of electricity at a state level in the US. So some states it's going up 30-40%. And so ironically, AI could be good for productivity in the long run and deflationary, but in the short term it could be inflationary and cause unemployment. So, there's a lot of change happening at the moment, so I wouldn't know too much about the tulip bubble, but compared to last time out in 2099, I would say that's...
You've got to look at things like the PE ratio to sort of see, well, what is driving the change in prices of these companies. And if you go back to the tech bubble, that was all about the change in the PE ratio, because the earnings weren't coming through in quite the same way, whereas today the price gains that we've seen are all supported by earnings. So for us, they might be slightly expensive, but they are not in the same sort of bubble territory as we saw back in the 2000s.
That's right. Historically, we can now look back and say the emperor had no clothes. A lot of those companies had never had any earnings, let alone profits, and yet these valuations went sky high. This time, however, we are talking about some major US companies, for example, who, for the moment anyway, are backed by their own cash and earnings, and whilst earnings keep continuing to give investors some solace, higher valuations are justified. So we won't know until afterwards, of course, but it's difficult to see that we're in a bubble at all, despite the media headlines.
Okay, we've had a few questions about the UK. Richard, possibly for you here. What direction for UK equities, given the worsening economic data and a government unfriendly to business? Now, of course, we've got the upcoming budget, which is very much front and centre, and that's creating a lot of uncertainty for consumers and businesses. But as we have discussed, the FTSE near all-time highs.
It's a good question, and it's a useful reminder that for the most part, the FTSE 100 has nothing to do with the UK economy. So whatever sort of punishing budget we may get next month, of course it will have second round effects on retailers, house builders and the like. But we've got a situation whereby about 70% of FTSE 100 earnings come from overseas, and in particular the US. At the same time, one of the reasons it's been held back over recent years is it's not seen as being as sexy as the US, because we've got
the Jurassic Park
very few tech stocks in there. But by the same token, when we looked the other day, S&P 500, the US benchmark, is trading on about 24 times earning. FTSE 100 is trading on about 11. So there certainly aren't any valuation concerns there. And there's also quite a big dividend gap. The average dividend yield in the FTSE 100 is about 3.1%. S&P 500 is about 1.1%. So the UK and FTSE 100 in particular, I should say, still has a lot of room for manoeuvre, I think.
Yeah, so it's still got that dividend allure, and the miners, of course, with where gold's at and silver's at, we've seen the performance of Fresnillo, for example. Another question on the UK, probably again for you, Richard, but feel free to jump in. What does the panel think of these two new IPOs in the UK, Shawbrook and Princes? And of course, this comes off the back of a period of weakness for flotations in London, many companies opting for New York instead, and we've seen some high-profile shifting of companies abroad as well. Not good for the PR of the City of London, but could that be about to change? You know, we recently had Beauty Tech's IPO. I checked the share price today, I think it's down 10% since its first day on the market. Nonetheless, do you think there are kind of green shoots of optimism kind of coming back?
You'd like to think so. I mean, the two you mentioned, both are going to have market caps of somewhere around £2 billion, so they're not going to be anywhere near the FTSE 100 for starters. Nonetheless, the CEO of one of those companies is anticipating a slight turning tide in terms of sentiment towards the UK. And there was an interesting comment from the stock exchange about 9 months ago, which looked at 20 companies which had either chosen to float in the States or had transferred their primary listing to the States. And for the most part, surprisingly, vast majority, turns out the grass is not always greener. And yes, you've got access to deeper pools of liquidity. You've also got more focus, and particularly on quarterly results as well. So it doesn't necessarily follow for all sectors that a US listing is better. And should it get to the stage where a trickle becomes a flood, things like Shawbrook and Princes could, you'd like to think, be the thin end of the wedge.
Okay, we've got another question here. It says, what are some of the low or medium risk investment options with lower inflation exposure aside from gold? Because we know obviously gold has been talked about a lot, and we've talked about kind of protecting the portfolio and looking for more safe haven assets. Where else can investors look? Dorian, maybe for you?
Well, to start, but I'll hand over to you in a second. I mean, I think we're going to agree on this, probably the short end of the curve in terms of short-dated fixed income investments as a kind of barbell approach with your growth opportunities elsewhere. I mean, we would just say, you know, try and be as broad as you possibly can and look for drivers that aren't totally correlated. So, you know, because there is an argument that AI is one trade. So probably trying to look beyond that, look at banks, as you were saying earlier. You know, oddly enough, European banks trade 10 times or less and can pay you back around 20% plus in terms of dividends and share buybacks over time. So without a positive.
So I agree. So we would have, I think, similar concerns to you, that you could see yield curve steepening, whether it's in the US or potentially still in the UK as well. But we would still hold government bonds as part of a multi-asset portfolio because they do provide protection in times of stress. Where we are sort of building those fixed income exposures, though, we are barbelling that with an exposure to short-dated credit. We think you can still get decent yields there, but you have less of the susceptibility to some of the stresses that could come through, whether it's in the credit markets, but also taking away some of the risk of higher yields further out as well. So short-dated credit is the sort of the interesting space for us at the moment as part of those multi-asset portfolios.
All right, thank you so much, everyone, for a wonderful discussion. I've learnt so much from our fantastic panel here today. Lots of takeaways, gold making up a small part of the portfolio overall, despite all of those uncertainties out there. AI bubble, I think the jury's still out. We've got mixed opinions from our panel here. The outperformance of the UK this year, thanks to mining stocks, has been a bit of a theme that's come up. We talked about the US dollar and the weakness, and you talked about how it's not necessary to always hedge portfolios there, particularly with what we're seeing in terms of price action, because it can help to diversify things, and lots on bubbles and the potential for further growth in the UK market and a revival in IPOs. Just a few of the things that we've talked about today. So thank you so much, everyone, for listening today, and a huge thank you to our panel. We've got Richard Hunter, Head of Markets here at II, Simon Fox at the end, Global Head of Multi-Asset Bespoke Solutions at Aberdeen, and Dorian Carrell in the middle, Head of Multi-Asset Income at Schroders. And we'll be hoping to see you here soon for another webinar. If you would like to watch it again or share it with your pals, or if you'd like to recap on anything, replay is available. If you've missed something, you can go back and catch that. And also, we'd love to hear from you in terms of feedback, so we can tailor these events to exactly what you would like to hear and make them better and better. So you will get an email asking for feedback soon, so make sure to respond if you possibly can. And finally, if you did enjoy today and you'd like to hear more from us on YouTube, then please click subscribe below. Thank you and goodbye.